Welcome to Zero Noise.
The only show that strips out the narrative fluff and really forces you to stare directly at the raw mechanics of the market.
I'm Bella Vega. My job here is to be your signal-to-noise filter. I look for the mathematical anomalies, the regime shifts, and, well, the hard data that is completely indifferent to your feelings.
And I'm Michael Alpha. I'm here for the risk. I'm looking at who's off sides, where the leverage is buried, and right now I am smelling the distinct scent of burning premiums in the options market.
Today our mission is to interpret a market that is, well, it's suffering from a severe case of split personality.
That's putting it mildly.
We have commodities and volatility screaming panic. At the same time, corporate credit is screaming nirvana.
It is a bifurcated reality. Usually when the fire alarm goes off, everyone runs. Right now, half the market is running for the door, and the other half is, ordering another round of drinks.
So we're going to break this down systematically. First, the macro snapshot, that big rates-led rotation we just saw.
Then we'll get into the asset signals, the collapse of Dr. Copper.
And the historic multi-sigma ascent of gold.
And then we get into the plumbing. The really interesting stuff, why the 60-40 hedge is suddenly back from the dead, this upside panic in the VIX.
And why the systemic risk dashboard looks so calm when traders are sweating through their shirts.
Finally, we'll hit the tariff premium and vol pricing and the news that's actually driving all this. Let's get into it.
Let's do it. Okay, data window ending February 13th, 2026. If you only read the headlines this week, you'd assume your portfolio is just bleeding out.
Right, because the narrative was all trade wars, tariffs, walls going up everywhere. But if you actually look at the flows, capital isn't leaving the casino.
No.
It's just moving to a different table. And it's moving fast.
It is a classic rotation, but the magnitude is what matters here. Looking at the block data, the clear winner this month is fixed income.
No question.
The aggregate block is up roughly 1.4%, but the real story is the long end of the curve. TLT is up 2.3% on the week and a massive 4.4% on the month.
Which is, it's counterintuitive. Bond volatility exploded this week. The Movie E index was jumping all over the place.
Just was.
And yet the price ripped higher.
Yeah.
Usually volatility crushes forward income.
Exactly. And you compare that to equity, the S&P 500 is soft. It's down 1.4% on the month. The NASDAQ is even worse, down 3.2%.
Tech is taking it on the chin. That AI premium is getting a serious repricing.
And then real assets. This is where the divergence starts to look like, I don't know, a crime scene. Gold is up 9.4% in a single month.
That is a monster move. Almost 10% in 30 days for a shiny rock that doesn't pay you anything. That's not an investment decision. That's an exodus.
And finally, the disaster zone. Crypto. Bitcoin is down nearly 33% on the month.
Yeah, we'll get to that train wreck.
Yeah.
But I want to stick on this bond move for a second. There's an asymmetry here that's really bothering me. We have this higher for longer narrative solidifying. The delayed jobs data finally dropped on February 11th. It showed 130,000 jobs added. That is not a recessionary print.
Not at all. And usually, good jobs data is poison for bonds. It implies the Fed keeps rates high.
Right. Yield should go up, prices should go down. But bonds rallied. Prices went up. Why are people panic buying bonds if the economy is supposedly strong?
It's the flight to quality anomaly. Investors are decoupling the asset from the Fed. They're not buying treasuries for yield anymore.
They're buying them for what? Collateral?
Exactly,
Yeah.
as collateral. They're terrified of something else, and they are just parking capital in the bunker, regardless of the interest rate outlook.
It's pure fear bidding. They'd rather lose a little to inflation than lose everything to a market shock.
Which brings us to what that fear is actually pricing in, because if you look at commodities, the signal is deafening.
We have to talk about Dr. Copper.
Yes, we do.
So for anyone who doesn't stare at futures curves all day, they call it Dr. Copper because it has a PhD in economics. It moves on real industrial demand.
That's housing, manufacturing, infrastructure.
Exactly.
Yeah.
And right now, the doctor is calling it code blue.
We track the copper to gold ratio as a proxy for global growth sentiment. It has collapsed. It's at 0.00011.
Yeah, visualize a chart just falling off a cliff. It's a vertical line down.
To put that in statistical context, it's a 0.1 percentile reading. The z-score is negative 2.26.
Just quickly explain the z-score again so everyone gets the gravity of this.
Sure. A z-score measures how many standard deviations a data point is from its average. A score of negative 2.26 means this drop is an extreme statistical outlier.
So it's not just low.
No, it's historically rare. It suggests a deviation that should happen less than 2% of the time.
So mathematically, this is extreme growth pessimism. This is recession pricing, explicitly. If you're long copper, you're betting on growth. If you're long gold, you're betting on fear. And when that ratio crashes, it means the industrial complex is screaming that the global economy is just grinding to a halt.
And the gold breakout confirms the other side of that exact equation. Gold is currently a 3 sigma event.
3 sigmas. That's massive. That's a once-in-a-decade kind of move.
It is. The Z-score is plus 3.09 on the 1-year horizon.
So gold isn't an inflation hedge right now. It's acting as a geopolitical exit ramp. People are moving money out of the fiat system entirely. They see the trade wars. They see the fractures in Munich.
And they're buying the only thing that isn't someone else's liability.
Right. Now, let's address the other outlier you mentioned, the crypto flush. Bitcoin's Z-score is negative 1.86 for the month.
It is.
I'm seeing a lot of panic online about this.
Yeah.
This is the end. I disagree. This looks idiosyncratic.
The data supports that view.
I mean, we had that massive failure of the South Korean exchange on February 5th. That just triggered a liquidity cascade.
Yeah.
It's leverage getting flushed. It's incredibly painful if you're holding the bag, sure, but it's not a systemic signal like copper is.
Yeah.
It's a localized fire in a specific casino.
And this is the most important constraint in the entire data set. This is the bifurcation we keep talking about. While copper is screaming recession and gold is screaming fear, credit spreads are flat.
This is the part that keeps me up at night. This is the anomaly.
BBB investment grade spreads are at the 3rd percentile of tightness. The Z-score is negative 1.15.
Let's just unpack that. Corporate bond traders are supposed to be the smart money on bankruptcy risk, right? They sniff it out first.
They should.
And right now, they are sleeping like babies. They're charging almost no extra premium to lend money to corporations.
So you have commodity traders jumping out of windows, convinced demand is collapsing.
And bond traders are pricing in a perfect soft landing.
One of them is wrong.
Dead wrong.
Yeah.
You cannot have a global industrial collapse and 0 corporate defaults at the same time. The math just doesn't work.
So let's look at correlations to see how the market structure is handling this tension. This is where we see the old 60-40 portfolio dynamic shifting again.
The broken hedge is suddenly fixed.
The 1-month correlation between equities, the SPY, and bonds, TLT, is negative 0.96.
Negative 0.96. Okay, so that's effectively a perfect inverse relationship.
And the context is key here. The 6-month correlation was basically 0. So the rate of change, the delta, is negative 0.97. That is a massive structural shift.
Bonds are back as a hedge. For the last couple of years, stocks and bonds just moved together.
Right. They both went down.
Killed the whole diversification idea. But now, when stocks tank, bonds rally hard. The question is why?
Why the sudden shift?
Because the market has moved to binary positioning. It's just risk on versus risk off. If you sell stocks, you buy bonds. There's no middle ground. Liquidity is just sloshing back and forth between 2 buckets.
Well, here's the number that makes my head hurt. The correlation between the S&P 500 and the VIX.
Oh, this is the fun one. This is where the psychology gets really weird.
The 1-month correlation is positive 0.54.
So for the non-quants listening, stocks go up. Volatility is supposed to go down. The correlation should be negative.
A positive correlation means stocks are going up and volatility is going up.
Yeah, or stocks are flat and vol is just ripping higher. We call this upside panic.
Explain the mechanics of that. It's bizarre.
Investors are terrified. They're terrified of the macro risk, the trade wars, geopolitics, so they're buying puts for protection. That drives VIX up.
Okay, that makes sense.
But
They're
also terrified of missing the rally. They see AI stocks, they see tech, and they have massive FOMO. Okay. So they're buying calls aggressively.
So they're buying crash insurance and lottery tickets at the same time.
Precisely.
Yeah.
And the dealers, the market makers, they're caught in the middle. They're likely short gamma.
Which implies what?
It implies that as stocks rise, dealers have to buy more to hedge, which drives the market up further. As stocks fall, dealers have to sell, driving the market down. It creates this feedback loop where volatility stays high no matter which way the market goes.
Which brings us to systemic risk. With all this panic, is the system actually breaking?
Spoiler alert, no.
Our system turbulence metric is at 1.86. That's the 41st percentile.
Boring.
That is the whole point. Despite the tariff headlines, despite the copper crash, the mathematical structure of the market is holding up.
It feels chaotic, but it's an orderly chaos.
And the composite stress index is negative 0.15.
Negative stress.
Correct. There's no liquidity crisis, no counterparty risk showing up in the data.
The plumbing is fine. This is a pricing dispute. Traders are arguing over what things are worth, but the system for trading them is working perfectly.
Okay, so let's talk about the price of that argument. Volatility pricing.
Ah, yes. The tariff tax.
The VIX, which is implied volatility, what the market expects is at 20.82. That's the 73rd percentile.
So elevated.
But GRCH, which measures realized volatility, how much the market is actually moving, is only 16.7.
So there's a spread.
A spread of almost 4 points.
And that spread is the premium. Traders are paying a fat premium for insurance. They're paying 20 vol points for a market that's only moving 16 points.
The volatility risk premium is in the 81st percentile.
And why? Because nobody knows what the president signs next. Market makers are charging you extra because the policy environment is totally unpredictable. You want to hedge against a trade war? Fine. It's going to cost you.
It validates the idea that the market is expecting trouble that hasn't statistically arrived yet.
So where do we actually stand in terms of regimes?
Okay, we use a Markov switching model for this. Think of it like traffic lights for asset classes.
Green, yellow, red.
Credit, specifically high yield and investment grade, is firmly in low VUL green light. It's been there for over 40 weeks. This is the market's anchor.
The credit nirvana.
But Treasuries, TLT, have transitioned. They've moved to mid-vol yellow light.
And that realized vol on bonds exploded 77% week over week.
That is significant. The bond market is the source of instability right now. It is transitioning. And gold, it's been high GHVL for 23 weeks. Red light.
So the bond market is where the fight is happening. Credit is just watching from the sidelines, completely unbothered.
For now, but there is transition risk. If TLT shifts from mid to high HVL, it usually drags equities with it.
Right.
We need to watch the correlation between credit and equity. They're decoupled now.
But if they recouple, that's the contagion signal.
That's the signal.
Okay, let's talk about why this is all happening. Take us into the deep search. What news actually moved the needle this week?
There were 3 top market-moving developments.
Hit us with number 1.
The tariff shock. Specifically, the window from February 1st to the 4th, and then the reciprocal tariff framework on February 13th.
So Trump imposes 25% tariffs on Canada, Mexico, China.
Yes, and then follows up with the framework for reciprocal tariffs.
And why it matters. It shifted trade policy from just a negotiating tactic to, a structural regime change. The market realized this isn't a bluff. This is the new operating system.
And the most sensitive assets were copper because of growth fears and the VIX because of the uncertainty.
Number 2.
The rescheduled macro prints, the delayed U.S. jobs report on the 11th and CPI on the 13th.
Right. The government shutdown messed up the calendar. We were flying blind.
When the data finally hit, it was 130K jobs added, unemployment at 4.3%, and CPI headline at 2.4%.
And why that matters. It forced a massive repricing of the Fed. The economy isn't crashing, so rates stay higher for longer. That's what drove that bond volatility we talked about.
And number 3, the crypto liquidation on February 5th.
The South Korean exchange failed.
That's the one. It triggered a 30% drop in Bitcoin.
And why that matters. It explains why the crypto crash was idiosyncratic. It wasn't interest rates that killed Bitcoin this month. It was a specific structural failure.
Okay, now looking forward. The risk calendar for the next 7 to 10 days.
First up, February 25th. Canada's retaliation. We're looking at a $125 billion tranche of counter tariffs. That's going to hit the FX markets and rates.
We also have the ongoing U.S.-China tech friction. The accusations around OpenAI and DeepSeek are getting louder.
And that's a direct hit to tech equities, the NASDAQ.
And finally, the fallout from the Munich Security Conference, specifically VP Vance's speech post-February 14th.
That hits European equities and the euro. If the U.S. signals a more isolationist stance, you risk capital flight from the EU.
So if we map this on a probability versus impact matrix, where's the biggest risk?
High probability, high impact. It's the trade war escalation. No doubt. The reciprocal framework is totally open-ended. Markets hate open-ended risk.
And low probability, high impact.
Credit contagion.
Which brings us right back to our central tension.
Exactly. Spreads are way too tight. If that low vol regime in credit finally ends, the whole game changes.
Which brings us to the synthesis. We are in a bifurcated regime. It's a split screen.
Growth signals like copper are screaming recession. Financial signals like credit are screaming expansion.
One of them is lying. Usually the bond market, the commodity market, that's the smart money. They see demand destruction coming first.
Right. But right now, the credit market is the one refusing to panic. Corporations have termed out their debt. They have cash. They aren't scared.
So here's the final provocative thought for you to take away.
Lay it on us.
If the copper to gold ratio is right and global growth really is collapsing, Why are corporate bond spreads tighter than they've been in history?
Is credit the anchor that's keeping the whole market stable? Or is it just the last thing to break?
Because if credit breaks, zero noise turns into all noise very, very quickly. Keep watching the spreads.
Zero noise. Good luck.